So last week, my producer gave me a list of option strategies for me to rank them in the order in which I use them in my personal trading. For each of these strategies, I'm going to judge their rank based on the probability that each trade is profitable, riskiness associated with each trade, and the profitability associated with each trade as well. Let's get started. So the first one we're going to take a look at is selling iron condors. So selling iron condors is a strategy that aims to profit from a market movement that is more or less neutral. We don't really want the market to go up or down when we sell an iron condor, and typically the probability of profit when you sell an iron condor is right around 60 to 70%, depending on the strikes that you select. It's also important to know that iron condors are a risk-defined strategy, which means that at any point, no matter what the market does, there is a maximum amount of loss that this strategy could take, as well as a maximum amount of profit that this strategy could make. Now, I'm going to give this ranking a B. And the reason mainly boils down to the fact that when you sell a iron condor, you are risking a certain amount and you're making a certain amount. So the market will typically fall within one of two ranges, your profit zone or your loss zone. Personally, over many trials of selling iron condors, I've found that it's very easy to go on a good run with a lot of winners back to back. But when the market gets kind of crazy, it is kind of tough to make money consistently with this strategy. So if I rank it a B, it's not necessarily because it's a bad strategy, but its consistency will vary greatly depending on the type of market that you're in. All right, the next one is buying out of the money puts or buying naked put options. This one's an interesting one. This strategy is actually a very simple option strategy. It involves simply a one-leg transaction, meaning you're looking at one option and just buying it. And the gain of this strategy is that if you buy a put and the market crashes, this strategy is a good way for turning a little bit of money into a lot of money very quickly. Now, some pros and cons I associate with this strategy is that the probability at which this strategy will make money usually hovers in the 20% or less range. And the reason is because markets don't typically crash. And when markets don't crash, the value of the put option that you bought will typically approach zero very quickly. One of the pros, however, to this strategy is that this is a risk-defined strategy as well, which means that the amount of money that you put into this trade is the most that you could lose and no more. So although that sounds like a pretty good proposition, you're able to put a small amount of money into potentially making a lot of money, I'm actually going to rank this strategy in the D category. And the biggest reason I'm going to do this is because it is near impossible to predict when the market is going to go down. My personal experience with buying puts is that it's literally like buying lottery tickets, hoping for a very unlikely event. So it almost always turns out to be a gamble than any profit that I tend to pull out of it. Now, this doesn't mean that buying puts is an inherently bad strategy. I'm just talking from my personal experience. It's not a strategy that has produced a lot of gains. And really the only time I would incorporate this is when I want to hedge against an adverse market move or potentially save a portfolio from losing any additional gains in the event of a lot of volatility. All right, the next one I have is buying butterflies. Now, for those of you who haven't traded options, butterflies are a strategy that involves three legs of either a call or a put option. And the goal of a butterfly is that you are risking a relatively small amount of money to potentially make a lot of money by hoping that a price of a stock or an index moves to a specific number. What do I mean by this? Let's say you have Apple trading for $150 a share, and I think that Apple's going to go close to 180, but not a lot more or less than that. A butterfly will allow me to profit on this trade if Apple approaches 180 and doesn't move much from there. Similar to buying a put option, this strategy is also akin to putting a little bit of money into potentially making a lot of money, and the probability that this strategy pays out is also around 20% or less. Now, although this sounds similar to just buying a put option and quote-unquote gambling on the market moving where you want it to, this strategy is actually more effective than simply buying a put. The reason is because even though you're hoping to make a lot of money from a small investment, the cost for buying butterflies is far lower than simply going out and buying a put option, which means that the initial outlay that you're putting towards this strategy is a fraction of the amount that you would be if you were buying put put and hoping for a market crash. This simple fact makes this strategy personally for me in the A category. And the reason it's so drastically different is because when I'm managing a portfolio and I want to protect the portfolio against big moves, buying cheap butterflies allows me to not spend a lot of money while also being able to hedge my portfolio in the event that the market does move a lot out of my control. All right, the next one I have in front of me is buying or selling vertical spreads. Now, a vertical spread is a relatively simple option trade where you buy one put or call option and then sell another put or call option, same exact expiration date, but just different strike. Now, the goal of vertical spreads, or somebody who's trading them, is you want the market to go one direction or another. Vertical spreads are also risk-defined trades. In other words, the amount of money that you could lose on a vertical spread is defined, and the profit that you could make on a vertical spread is also defined. Typically speaking, vertical spreads will have a probability of making money of right around 50%. And although you can customize vertical spreads to be a wide variety of different strikes, typically the way I use vertical spreads is to bet on either an up move or a down move in the market with a defined risk or profit potential. Now, vertical spreads allow you to have a good control of your risk and reward. The only downside, though, is because on a day-to-day basis, we don't really know where the market's going to go. Choosing a direction and betting on it is also very similar to just flipping a coin. And for that reason, I'm going to put vertical spreads in the C category. It's an effective way to bet on a move in the market up or down while knowing at all times what your risk and reward is. But typically speaking, I don't use it that often because I don't know which direction the market's going to go almost all the time. So this is a strategy I would maybe use if I had a very strong hunch on any certain week or month, or if I wanted to protect a portfolio against a big move in either direction. So it's not really used often, therefore I'm giving it a C. Next one is selling an at-the-money put. So this is a very, very simple option trade, and it involves going into the market and selling a put option right where the stock is trading. So for example, if you have Apple trading at $100 a share, an at-the-money put option would be a put that has a strike price of 100. When we sell a put option, we ideally want the price of the stock to stay roughly where it is or go up. In the event that the stock goes down, if the put expires and the stock price is less than the strike price of the put, we will be assigned shares of that stock. In other words, we will have to purchase shares of that stock at the strike price of the put. Now, the probability of making money on selling a put is right around 55 to 60%. It's also important to note that the risk of this strategy is that the stock continues to drop and drop and drop, meaning that our worst case loss is technically if the stock goes to zero. Meaning, let's say we sold the 100 strike put in Apple, and Apple's trading at $100, and then let's say a horrible thing happens and Apple stock goes to $50, our loss on that trade would actually be the full $50 minus the amount that we collected for selling the put. The amount of money we could make by selling a put is equal to the amount that we sold it for. So when you look at a risk-reward picture, the amount of money that you can make is limited, but the amount of money that you could lose is really up to where the stock ends up. Now, given all of these characteristics, I'm actually going to give this strategy our first S rank. And the reason is because when you are selling a put, you have the ability to make money, not just if the market goes up, but also if the market just stays right where it's at. In other words, unlike buying a stock and hoping it goes up, if you sell a put, let's say the stock doesn't do anything over the course of the put's life cycle, you still make money on the trade. Additionally, if the stock goes higher, you also make money on the trade because the put option that you sold will eventually trend to zero. meaning you get to keep all the credit that you sold the put option for. And finally, even though the risk of selling a put option is relatively higher than some of the other strategies, it's important to note that if the stock does eventually come down, you don't really have to get out of the trade if you're comfortable with owning the stock to begin with. So let's say, going back to our example with Apple, that you sell a 100 strike put in Apple, and Apple's trading for $100, and let's say Apple does have a poor earnings report or something happens and Apple ends up closing at $80 when your put option expires. Yes, you will have to buy Apple at the price that your put option stipulates, in this case $100, but the point is now you own Apple stock, and if it's a stock that you like to trade and own, you now have options after the put option expires. The next strategy we have is selling naked calls. Selling naked calls is essentially where we sell a call option on a stock, let's say Apple, and the point when we sell the call is that we want the stock to stay roughly where it's at or go lower. So it's essentially the opposite of selling a put, where if we sell a put, we want the stock to stay the same or go higher. Typically when we sell calls, we will also have a probability of profit of right around 55 to 60%. Or more depending on where the strike price of the call is. One of the downsides about selling a naked call that actually doesn't exist when you sell a put is that when you sell a call, you want the stock to stay the same or go lower. However, if the stock explodes and goes higher, there is now no definition of how much money you could lose. Similar to short selling, if you short sell Apple stock at $100 and Apple stock goes to 150, 200, 300, 400, you will now owe the difference between where you sold the stock short and where the stock is trading. Because of that, the risk of going short or selling a naked call is actually unlimited. Now, one of the nice things that you do get when you sell a call is that you get the credit that you sold the call option for, meaning that there is a buffer before when you start to lose money if the stock does go up. I personally don't really like selling naked calls in general because typically markets do go higher. When you sell calls, you're betting on the market staying roughly the same or lower, which means if the market does well, that's not good for people who sell calls. Because of all this, I'm actually going to give selling naked calls a B ranking. The reason I'm going to rank it B is because it is a useful strategy if you are betting on sideways movement in the market, which does happen quite often. The problem is if there is a big move higher in the market, this is where this strategy can really double whammy you. Imagine this, Apple stock is trading at $100 and you sell a call against Apple, meaning that you want Apple to stay roughly where it is or go lower. Well, let's say Apple does something really good and the market likes what it's doing. Apple stock could go to $150 or $200, and the key here is once the stock goes up, there is no certainty of that stock ever going back down. Meaning that if you're selling calls on a stock that's moving higher, you don't know if you're ever going to make back the losses that you've just incurred with selling calls. This is unlike selling puts because even if the market goes down, there's a pretty good chance that over time, the market or the stock will recover. All right, next is buying in the money calls. Opposite of selling calls, where we want the stock to stay the same or go lower, when we buy a call, especially an in-the-money call, we want that product to go higher. This strategy is also a risk-defined strategy, meaning that the amount of money that you purchased the call for is the most that you could lose no matter what happens to the stock. Additionally, on the upside, if the stock continues higher and higher, your call option will become worth more and more, meaning that you will make more money as the stock goes higher. Buying in the money calls typically will have a probability of making money of around 40 to 45%. When you buy in the money calls, you are really hoping for a sharp move higher in the stock that you're buying calls on. One of the downsides, however, is that if you buy a call on a stock that goes higher and it does go higher, you could actually still end up losing money. And the reason is if you buy a call option where you are risking a certain amount of money, but you could make an unlimited amount of money, there is a certain cost to making that trade, which is called the premium. If the stock does not go higher in the time frame at which you owe the option, that option could actually be worth less than when you bought it, even if the stock goes higher a little bit. So remember that if you buy an in-the-money call, the stock has to go a lot higher for you to see any profits. That's why I'm going to give this also a C ranking. It's not a bad strategy if you're very bullish on a particular stock, but in order for you to even make money, you have to first recoup the premium that you bought the option for, which involves the stock going up probably more than you expect. The next one we have is selling a strangle, which is selling a put and a call simultaneously. Now, we've already gone over the risks and rewards of selling a put and selling a call, so selling a strangle will be kind of the middle ground between the two. When you sell a strangle, one of the biggest benefits to doing so is that you will get the credit from both the put and the call. The goal of this strategy is for the stock or index not to move outside of a certain range. In other words, when you sell a strangle, the ideal outcome is that when the option expires, the stock is ended up pretty much where it's at. The downside of selling a strangle is if there is a huge move in the stock, either up or down, you will start to lose money on this trade. If we look at the historical backtest of selling strangles, typically the stock doesn't move as much as people expect it to move, which means over time, selling strangles will typically be profitable with the occasional big move in the stock that could take out some profitable trades. Because you are selling both the put and the call option together, you get a much larger premium than if you were to just sell the put or the call. This means that the area where you break even is a lot wider, which allows for the stock to have some movement before you start taking on losses. So remember, because you're selling a put and a call using this strategy, if the stock has a huge move, this strategy could become a loser. And like the attribute of selling a naked call, where if the stock goes higher, the potential losses could be unlimited, this is also true with the strangle. The benefit is that because you have sold the put and the call option, you have a lot wider range where the stock can move before you start taking any losses. And if the stock does stay within that range, then you actually could make a lot of money on a stock that doesn't do much. That's why I'm going to give this strategy an A rank. Although it does carry risks, especially with big moves higher in the stock, more often than not, stocks will tend to stay in a range more than they will make huge moves. Because of this, selling a strangle is a popular strategy that can benefit in a stagnant market and allow you to make some money on things that just aren't moving. The next one we're going to look at is buying out of the money calls. So we already looked at buying out of the money puts, where you want the stock to crash if you buy the put to make money. This is similar, where you want the stock to go up a lot in order to make money. When you buy an out of the money call, you will typically spend a limited amount of money in hopes of making a bigger return. The risk profile on this strategy is limited to the amount of money you will pay for the call option, and the potential profit is technically unlimited. When you buy a call option, you're hoping that the stock goes up as much as possible. Because this is a strategy where you're risking a little to make a lot, the probability that the strategy works out will typically range somewhere between 20 and 30%. So it's not that high of a probability of making money, but when you do make money, typically you're going to make a lot. One thing to note when you buy out of the money calls. We've talked about this before, but this is important for this strategy. Typically, stocks do not move as much as the market predicts it, which means that when you buy an out of the money call, you are hoping for the stock not just to move higher, but to move higher by a lot. And what ends up happening is, over a lot of occurrences, you will end up losing more money than you will make, because stocks just typically won't make as big moves as the market predicts. This is similar to the outcome of buying puts, where the stock market just doesn't crash often enough for buying puts to be profitable. Because of this, I'm also going to give buying calls a D rank. Although it is a good way to risk a little to make a lot, more often you're going to end up just spending money on lotto tickets that don't ever materialize. All right, the last strategy we're going to take a look at is selling a covered call. Now, selling a covered call actually involves a stock component, which is the first strategy of its kind in this list. When you sell a covered call, you're going to have at least 100 shares of a certain stock that you own, and then you're going to sell an out-of-the-money call on it. What selling a covered call does to your portfolio is it allows you to take in some additional credit and reduce the cost basis at which you bought your stock. Additionally, if the stock doesn't move a lot while you have this covered call on, you actually end up making the money that you sold the call for. The one downside of selling a covered call, though, is that it limits your upside, meaning that if you own a particular stock, you ideally want it to go up as much as possible. But when you sell a call, you end up capping the amount of money that you'll make when the stock moves higher. This, of course, is a trade-off for taking in premium that will reduce the cost basis. If the stock that you sold the call on will go a lot higher, what will end up happening is when the call expires, your stock will be called away. When a stock is called away, it means that you no longer own the stock and you will sell it at the strike price of the call. Now, although this is not the end of the world, some people who own their stock don't necessarily want to sell out of it early. So people who sell covered calls on the stocks that they own have to be wary that if there's a huge move higher in the stock, they may not end up owning that stock anymore. One of the nice things about this strategy that separates it from the rest is that you will sell an option on something you already own. So the worst case scenario is that the stock goes lower, you end up making the premium that you sold the call for, but now the stock that you own is worth less. In the grand scheme of things, however, this is better than having not sold the covered call and just having your stock go lower. The other option, of course, is if the stock doesn't do much and you get to keep most of the premium that you sold on the call. Therefore, your cost basis on the stock is also reduced. That's a good outcome too. And the final outcome, of course, is that the stock goes higher and your stock gets eventually called away, maybe sooner than you would have liked. Either way, selling a covered call will end up reducing the overall risk of your stock position, reducing the cost basis at which you bought your stock, at the trade-off of that, if the stock goes higher, you might have to sell it earlier than you would have liked. Because of all of this, I'm actually going to give a covered call an S tier ranking. Again, one of the beautiful things about selling options is that you get to expand the ways at which your portfolio can make money. Selling a covered call does exactly that. If the stock that you sold the call on doesn't really move much, you will be very happy that you sold the call because now you get to keep the premium that you collected on the call. It also helps reduce the risk of your position. And the worst case outcome is that if your stock goes lower, well, hey, at least you had the covered call to offer some buffer. Thank you so much for watching this. If you have any other tier lists that you want to see us cover, please drop it in the comments below. Thank you so much for watching, and we'll see you in the next one. Bye-bye.